Hello, guys, and welcome back to another episode of the MD Investor, the channel where we talk about personal finance, setting goals, achieving goals, and breaking the cycle of generational poverty. Um, if you're new, welcome. This is what we do. If you're a regular, you already know. Today's episode, we're going to talk about retiring in the down stock market. Let me say that again. Retiring in the down stock market. It can be a scary thing, right? So let's get into it. So we spent all these years working, saving, investing, trying to get a compound interest, all of that, just so one day you have a nice nest egg that you can live off comfortably. That's the ideal goal. But no one ever told you that you're going to retire in 2022 and there's going to be a war, there's going to be very high inflation, there's going to be supply chain issues, um, impending recession, global pandemic. Nobody told you about this. So I got a couple of stuff here about. So what do you do if you are gonna retire in this time where all of the forces of hell basically are aligned against you? So number one, you want to have cash reserves during retirement. The same way that we talk about having an emergency fund, just in case you lose your job and your income from your salary is gone. It's the same way we think about having a cash reserve in retirement, right? The recommendation is, 2 to 3 years, right? The thinking being, it takes about 18 months after a stock market decline for the market to recover. And they want you to have cash so you can live off. So you don't have to sell your investment when the market is low, right? The whole idea is buy high and sell low. You don't want to sell low because you're going to eat up your nest egg much quicker, okay? As you're going into retirement, maybe the last 1 to 2 years, they say their recommendation is that cash should be in a vehicle that is easily accessible. Cash, basically, it shouldn't be invested. So a money market or something where it's easily accessible. Or the other money that you've been investing for 20 years, 30 years, all of that stuff can be in your stocks. But the last couple of years, put that money in cash or money market or something. It's a cash vehicle, so you can have it in case you happen to be retiring in a year like now, 2022, or maybe in a year like 2008. Okay, you want to have that because you don't want to have to sell your investment at a loss. But that's the first thing. Other recommendation. It's a good time to start thinking about risk tolerance. We always talk about when the market is down like it is now, it's a great time because stocks are on sale. But that's true only if you have time on your side. If you're a younger investor, you're 20, you're 30, and the market is down, go ahead, keep buying, because you know that when the market does return, you're going to be getting, you're going to see the benefit. You're going to buy stocks on sale, and then when the market recovers, you will benefit from it. But if you're already in retirement, you don't have that time, right? You don't have that time. You need money, you need income to live off now, and you don't want to have to sell your investment. So you got to think about your risk tolerance. You're an older person. This is why you want to think about asset allocation. Okay, so we recommend you have a portion in bonds. Let me go back. That's why we recommend you have portion of your portfolio in bond, portion in stocks. As you're younger and you can take more risk and you have more time on your side, in case the market were to go down, you have more stocks. So you can have 100% in stocks. You're 20, 25, 30 years old, 100% in stocks. If the market goes down, you have time to recover, right? And you can buy actually at a discount when the market is low. As you get older, closer to retirement, you have less time to recover from losses. So at that point, you want to have cash. That's one option, or a portion in bonds. The reason why, when stocks are down, bonds are probably going to be doing better. They're going to be less volatile. The returns on stocks are higher, but the risk is also higher. The return on bonds are lower, but it's also less risky, which is what you want as you're getting older. Okay? So they recommend your bond portfolio should be your age. So if you're 50 years old, 50% stocks, 50% bond. To me, that's a little conservative because you need growth. Some people recommend your age minus 10. So if you're 50 years old, 50 minus 10, so 40% bond and 60% stocks. Some people recommend your age minus 20. So if you're 50, 50 minus 20, you'd have 30% bond and the rest in stocks. So that is number 3, you're rebalancing. And here's the thing, when stocks are down, like we are now, your bond would probably be higher. Because you look now and see the return on the market is down. The S&P 500 is down 20% year to date, while bonds may be either even or maybe a little gain. So as your stock portion getting smaller because of losses, the bond is getting higher. So what you do, you rebalance. Essentially, you're going to take the gain from your bond and buy more stocks, and vice versa. Okay, so when the bonds are down and the stocks are up, you take some of your stock money and buy bond. That way you can kind of keep an even keel. Number 4, if you happen to be retiring at a time like such as this, where the market is down, you may want to work a little longer. Maybe you work another 18 months, maybe work another 2 years. And the benefit of that is that you'll be able to have your income from your job to live off for another year or 2 while the market recovers. I mean, it could be at your same job or it could be at a different job. The bottom line is you just want to have additional income so you won't have to sell your stocks at a loss. So you retire at a later age. And just remember, you could also claim Social Security at several ages. You could claim Social Security at age 62 or age 67, the full retirement age, or age 70. So you have a little flexibility in when you claim Social Security, okay? So that's all I have for you guys. It is a very stressful time. It's a concerning time. And if you're retiring during this time, it's also very stressful because you're seeing your portfolio losing value. Okay, so quickly we'll review. If you are in a situation where you're retiring and the market is dropping, cash reserve is something you want to think about as you're going into retirement. Or if you're a year or 2 from retirement, think about it. Cash reserve. Instead of maybe investing into the market now, maybe put some money into the cash reserve, because they said 2022 and 2023 it's we're going to be in bear market territory. Anywhere between 2 to 3 years you want to have of cash saved. Your risk tolerance. Number 2, you want to think about your portfolio and how much risk you can actually take. You can take less risk now when you're close to retirement than you can at a younger age. Number 3, you may want to rebalance your portfolio. So if the bonds are doing good, you want to take some of that and maybe buy some stocks at a discount while you're living off your cash. And number 4, you may want to work for another couple of years, maybe another year or 18 months, another 2 years, just so you can now live off your income, your salary, as opposed to selling stocks at a loss. Again, guys, that's all I have for you today. And again, this is the MD Investor, where we try to increase our financial IQ so we can break the cycle of generational poverty. If there's a friend, family member out there, maybe one or two people who you think could benefit from the information, let them know about the MD Investor on YouTube. It's MD Investor. And this is the MD Investor out. And I will see you on the next one.